Good morning. Let me continue the previous sum. Okay, in the last class I had solved, I had passed 6 journal entries. Now 6 more I will pass in this class. Okay, so first I will write the rules. Capital plus liabilities is equal to assets. Okay, increase should be debited, decrease should be credited. Here increase should be credited, decrease should be debited. This is modern approach. Okay. Now next transaction is December 10th received commission rupees 2000. What? Received commission rupees 2000. Business is receiving commission. So the accounting equation is capital plus liabilities is equal to asset. Now business is receiving commission. So in the form of what? In the form of cash. It is receiving commission in the form of what? In the form of cash. And when it receives commission, it's a type of income. Due to which, what happens? My capital balance will increase. My capital balance will increase. I cannot write capital here. Instead, what should I do? I should write the reason behind. I should write the reason for the increase in capital. What is the reason for increase in capital? Commission. Commission received. Commission received. What is the reason for the increase in capital? Commission received. Increase in capital should be credited. Increase in capital should be credited. Cash is asset. Increase in asset should be debited. Okay. So, what is the journal entry? Date of the transaction is December 10. December 10. What should be debited? Cash. Cash account debit. Cash account debit to commission account. Cash account debit to commission account. What is the amount? Rupees 2000. How much? Rupees 2000. Okay, here commission received. Narration is commission received. Okay, this is the transaction. Now, let me solve this according to the traditional approach. Traditional approach. Now, business is receiving commission. So, take up any transaction, it will affect two accounts. First, you should find the accounts which are affected. Which are the accounts which are affected here? Cash and commission. Business is receiving commission. Business is receiving commission. Now you should identify the type of account. When it is receiving commission, so it's a gain. It's a gain. So which account rule? When it is related to expenses, losses, incomes and gains, which account rule we are supposed to follow? Nominal account rule. Debit all expenses and losses, credit all incomes and gains. Cash is an asset. For asset, which account rule we have to follow? Real account rule. What does real account tell? Debit what comes in, credit what goes out. Debit what comes in, credit what goes out. Here, it's a gain. So, I will consider credit entry from this. It is not an expense. It's a gain. So, I will credit commission. So, what is happening to my cash? Business is receiving commission in the form of cash. It is coming in or going out of the business? It is coming in. So, I will consider debit as. What should I debit? Cash. What should I credit? Commission. Okay. So, this is the journal entry. So, moving on to next transaction. Next transaction is, okay, next transaction is paid salary rupees 2000. Business is paying salary. How much? Rupees 2000. So, what is happening? My cash balance is declining. In the form of what? Business pays salary. In the form of cash. in the form of cash. So take up any expenses, profit, it will have impact on what? It will have impact on the capital. Okay, when business incurs expense, what happens to my capital balance? My capital balance declines. What happens to my capital balance? It will decline. But I cannot write here capital directly. So what should I do? I should write the reason behind, I should write the reason for the decline in the capital. What is the reason for which my capital is decreasing? Business is paying salary. Okay, decline in capital should be debited. Decline in asset should be credited. Should be credited. So, what is the date of the transaction? December 10. December 10. Okay, salary account debit. Salary account debit to cash account. Salary account debit to cash account. How much salary the business is paying? Rupees 2000. How much? Rupees 2000. Okay, salary paid. What is the narration? Salary paid. Okay, now according to modern approach, a traditional approach. Sorry, this is according to modern approach. Now according to, let me solve this according to the traditional approach. Which are the two accounts affected? Salary and cash. Business. What is the give aspect? Business is giving cash. Okay. What it is receiving? It is receiving service. It is receiving service and it is paying salary. Okay. It is taking service. It is taking service. It is getting its work done. Okay. So, by making payment of salary, it is receiving what? It is receiving service. What is the give aspect? Cash. Okay, now salary is an expense to the business. Salary is an expense to the business. Take up any transaction, it will have two effects. Give effect, take effect. Here give effect is cash. Take effect is salary. It is not taking salary, it is paying salary and receiving services from its employees. Okay. Now here, salary is an expense. Salary is an expense. The type of accounts which are affected is salary and cash. Salary is an expense. Which account rule? Nominal account rule. What does nominal account tell? Debit all expenses and losses, credit all incomes and gains. Okay, cash is an asset. For asset, which account rule? Real account rule. What does real account tell? Debit what comes in, credit what goes out. Debit what comes in, credit what goes out. Now, what is happening? Business is paying salary. It is an expense. So, I will debit. I will not consider credit entry from this. I will debit salary. Now, cash is an asset. What is the rule? Debit what comes in, credit what goes out. So, what is happening to my cash? It is going out. So, I will credit. So, salary account debit to cash account. What should I credit? I should credit cash. Okay. Now, moving on to the next transaction. December 12, goods returned by Sohan, rupees 1500. Goods returned by Sohan, rupees 1500. Now Sohan is returning goods. Okay. Sohan, what was Sohan? Sohan was our customer. We had sold goods to Sohan on credit. Now goods are returned by Sohan. Okay. So goods are returned by Sohan. So what is happening to my goods balance? It is increasing. We had sold goods to Sohan. Our business had sold goods to Sohan on credit. So after he has found some damages in the goods. Okay. So he is returning back those goods. So what is happening to my goods balance? It is increasing. And what is happening to my debtor balance? It is decreasing. The value of my debtor balance is decreasing. See, I recorded some amount in Sohan account. He had purchased goods worth of rupees how much? Worth of rupees 5,000. Out of 5,000 goods, check the question. December 6th, in the December 6th transaction, our business had sold goods to Sohan worth of rupees 6,000. Now, worth of 1,500 goods he is returning. He is returning because there are some damages. So, think from the viewpoint of the business. What is happening to my business? He is returning goods. My goods balance is increasing. He is returning goods. So, what is happening to my goods balance? It is increasing. There is a sales return. I cannot write goods here. I should write the reason behind this. Okay, what it is? Sales return. What it is? Sales return. So I had recorded he should pay 6,000. Now in his account I have recorded 6,000. Now I should decline his balance. Okay, so my debtor value is decreasing. By how much? 1,500. Okay, it is asset. Sales return is he is returning goods. Goods is a asset. So increase in asset should be debited. So sales return should be debited. Sohan is also a asset. He is a debtor. Okay. So decrease in asset should be credited. So what should be my journal entry? My journal entry should be December. What is the date of the transaction? December 12th. Okay, December 12th. What should I debit? Sales return account debit. Sales return account debit. Okay, to Sohan account. To Sohan account. Goods returned by Sohan. Goods returned by Sohan. Okay, so how much? Rupees 1,500. Okay, now let me solve this journal entry with the help of the traditional approach. With the help of the traditional approach. With the help of the traditional approach. So what is happening in this transaction? See, there are two accounts which are affected here. Goods are coming in. So I cannot write goods here. Instead, what should I write? I should write sales return. Instead, what should I write? I should write sales return. Okay. So, goods are coming in. Who is returning these goods? Who is returning? Sohan. Sohan is a person. So, which account rule? Personal account rule. Debit the receiver, credit the giver. Debit the receiver and credit the giver. Okay. So, he is returning goods. Goods is a asset. Which account rule? Real account rule. Debit what comes in, credit what goes out. Debit what comes in, credit what goes out. So, what is happening here? Sohan is returning goods. It is coming in. It is coming in. So, I consider debit aspect. Okay. Debit the receiver, credit the giver. Sohan is the giver. He is returning goods back. So, what is the journal entry? Sales return account debit to Sohan account. Sales return account debit to Sohan account. Transaction December 18th. What is the transaction? Goods returned to Mohan. Goods returned to Mohan. Now, business had purchased goods from Mohan. See the transaction number December 5th. Okay. The business had purchased goods from Mohan. Now, he is returning back those goods. Okay. Business is returning back goods to Mohan. So after purchasing goods, business found that there are some defects in the goods. Now it is returning back those goods. So what is happening to my goods balance? My goods balance is decreasing. The goods balance is decreasing. And business had purchased goods from Mohan. Mohan was our liability. Mohan was our liability. Okay. So, and my liability is also decreasing. We had purchased goods on credit. It had resulted in debt to the business. Now, my debt is decreasing. My account balance is decreasing. My liability is decreasing. And my goods is also decreasing. I cannot write goods here. I should write the reason. What type of return this is? Purchase return. Purchase return. Okay, goods is a asset. Decreasing asset should be credited. Mohan is a liability. For capital and liability, increase credit, decrease debit. Here it is decreasing. So what should I do? I should debit Mohan account. So what is the date of the transaction? December 18. December 18. So Mohan account debit. Mohan account debit to purchase return account. To purchase return account. What is the value of the goods which is being returned? Okay, it is ₹1000. ₹1000. Summation: goods returned by Mohan. Goods returned by Mohan. Okay, so this is the entry. Now, according to traditional approach, so in this account, identify the type of accounts, analyze the type of accounts which are involved. Goods sold, goods returned by Mohan. So it is affecting goods. I cannot write goods here. Instead, what should I write? I should write the event name. It's a purchase return. Okay. So if it is related to goods, which account rule? Real account rule. What does real account is? Debit what comes in, credit what goes out. Debit what comes in, credit what goes out. Okay. So he is returning goods. Who is returning? Mohan. Mohan. It will affect Mohan account. Now identify the type of account. What type of account Mohan is? Personal account. What does personal account is? Debit the receiver, credit the giver. Debit the receiver and credit the giver. Now here, so what is happening? Purchase return. It is going out. Okay, so the rule is, personal account rule is, debit the receiver and credit the giver. Okay, debit the receiver, credit the giver. Okay, and here the real account rule is, debit what comes in, credit what goes out. Debit what comes in, credit what goes out. So what is happening to my purchases? You are returning goods, so it is going out. So I will consider credit from here. I will consider credit. Credit what goes out. So Mohan is what? Mohan is the receiver. Mohan is the receiver of the goods. So I will consider what? I will consider debit aspect from this. I will consider debit aspect from Mohan. Mohan account debit to purchase return account. Okay, next transaction. Next transaction is cash received from Sohan ₹1,200. Business is receiving cash from Sohan. So what is happening to my cash balance? It is increasing. Cash received from Sohan. Who is Sohan? Sohan, you had sold goods to Sohan on credit. Now he is paying that cash. So he is a debtor. Who is Sohan? He is a debtor. Okay. So what is happening to my debtor balance? It is decreasing. It is decreasing. Okay. Sohan is a debtor. Okay. So he had purchased goods worth of rupees. See the transaction. December 6th, you have sold goods to Sohan for ₹5,000. Out of which he has returned 1,500 goods. Now he is paying cash. Worth of rupees how much? ₹1,200. So debtor balance is declining, and there is increase in the cash. Increase in asset should be debited, decrease should be credited. So what is the journal entry? December 21st. Okay, December 21st, cash account debit to Sohan account. How much? 1200. Narration. Cash received from Sohan. Okay, so this is the journal entry. Now, according to traditional approach, what is happening? Cash received from Sohan. Cash business is receiving. Sohan is a person. Cash is a asset. Real account rule, debit what comes in. Okay. Credit what goes off. Sohan is a person. Which account rule? Personal account rule. Okay. Debit the receiver, credit the giver. Debit the receiver and credit the giver. So cash is coming in. So I consider debit aspect from this rule. Okay, from this rule, Sohan is the giver. So I will consider what? I will consider the credit aspect. Okay. Hope you all are understanding. Now last transaction. Purchase furniture from Deepak rupees 5,000. Business is purchasing furniture from Deepak. Okay, for rupees how much? For rupees 5,000. Okay, now here what is happening? Asset. Furniture is asset. It is increasing. Business is purchasing furniture from Deepak. He has given. He has not given, he has not mentioned any information related to cash. That means what type of purchase this is? Credit purchase. And this has resulted in the creation of what? The liability. The liability is increasing and the value of assets is also increasing. Why? Because business is purchasing furniture on credit. So it has resulted in the creation of a liability. Deepak is a liability. Okay. So increase in liability should be credited. Increase in asset should be debited. Okay, so what is the journal entry? December 25th. Last transaction. Furniture account debit to Deepak account. Okay, purchase furniture on credit. Okay, what's the value? It is 5,000. Okay. Now, if I apply traditional approach to this, okay, so what happens? Which are the two accounts which are affected? Deepak and furniture. Deepak is a person. Personal account rule. Debit the receiver, credit the giver. Furniture is a asset. Debit what comes in, credit what goes out. So furniture is an asset. Business is purchasing furniture. It is coming in. So I will consider debit aspect. So Deepak is the giver. Okay, I will credit Deepak. Okay, thank you.